Let's dive right into the crypto market for June 20th, 2026. Now, if you just glance at the vibrant, almost comic book style green numbers flashing on your screen today, you'd probably think, hey, the bulls are back in control, right? But actually, scratch that. What we're really looking at is a high stakes, highly kinetic financial battle. That surface rebound, it's masking a very fragile illusion.
Which brings us to the core question of this explainer. If the market is up today, why on earth are institutional investors sprinting for the exits? We're going to unpack the mystery behind today's green charts and, well, reveal the deep systemic headwinds lurking just beneath the surface. We're talking macro forces, supply shocks, and a massive cyber threat, all converging at once.
Okay, so let's start with the immediate price action. Bitcoin has staged a modest technical bounce. It's up about 1.88%, trading right around $63,555. This uptick, it's primarily being driven by some temporary relief in the macro environment. We're seeing easing geopolitical tensions in the Middle East, specifically reports of a potential ceasefire agreement, and that's temporarily dragged global oil prices down. That little dip in oil has momentarily boosted risk on sentiment across the board. But is this fragile illusion of safety actually sustainable? To answer that, you have to look at this massive tug of war we're currently watching. On one side, we've got retail investors bottom fishing. They're bravely buying the dip, warming up to these lower prices. But on the flip side, massive institutional defensiveness. I mean, we have seen over $226 million in outflows from spot Bitcoin ETFs just this week alone. So the real takeaway here is that while small-scale traders are stepping in, the heavy institutional capital is deeply, deeply cautious, and that severely limits any clear directional momentum. So to understand why the big players are fleeing despite all this retail enthusiasm, we have to look at the overwhelming antagonists in our story right now. There is this massive macro-gravitational pull coming directly from the Federal Reserve, combined with some genuinely brutal supply-side threats. The days of relying on a rising liquidity tide to lift the crypto market, yeah, those are over. Just check out the sheer scale of the hawkish shock we just got. 9 out of 18 Fed officials now project at least one rate hike in 2026. 6 of them actually project 2. To put that into perspective, back in March, exactly 0 officials projected a hike for 2026. This aggressive shift has effectively, killed the rate cut trade that so many investors were heavily banking on for the second half of the year.
And that hawkish tone, it is being set right at the top. Fed Chair Kevin Warsh delivered a stark, 114-word statement that completely wiped out 14 years of forward guidance habits. He literally just said, this committee will deliver price stability. That's it. No promises of future cuts, meaning non-yielding assets like Bitcoin now face brutal competition. I mean, why hold a volatile, non-yielding asset when you can grab a 4% risk-free return on U.S. Treasuries? The opportunity cost has fundamentally changed. But the Fed isn't our only antagonist today. Let's pivot over to the supply side. $78,000. That rigid number represents the estimated production cost to mine a single Bitcoin right now. And as we all know, the current trading price is hovering way, way below that, down in the low 63,000s. This creates a really brutal dynamic, miner capitulation. Bitcoin is now traded below its production cost for 5 consecutive months. This relentless squeeze is forcing roughly 20% of all miners to operate at a loss. And to keep the lights on and stay solvent, they're being forced to sell off their hard-earned Bitcoin reserves. It adds this massive, continuous layer of supply-side selling pressure that the bulls just have to constantly absorb. And, as if the economic gravity and supply pressures weren't enough, enter a sudden plot twist. We just got an emergency alert from CISA regarding a massive digital infrastructure risk. It's being called the 40 Bleed cybersecurity crisis. This isn't just about financial markets. This is about the underlying plumbing of the internet itself. 74,000. That is the staggering amount of Fortinet firewalls and VPN gateways exposed globally in this unprecedented leak. We're talking usernames, email addresses, and plain text passwords for tens of thousands of organizations. That includes critical infrastructure, government agencies, and major defense contractors. And guys, this is not a drill. A Russian-speaking threat group has actively conducted roughly 1.16 billion, with a B, credential attempts. They are actively exploiting these globally right now. They even cracked SSL VPN authentication hashes using a massive 45 GPU cluster. It just proves that systemic risks in our digital economy aren't purely financial. They're highly infrastructural, and it's keeping institutional risk managers absolutely on edge. Okay. I know that is a lot of macro gloom and cyber anxiety, but let's look at where the positive momentum is actually hiding. Despite the heavy gravity pulling down the majors, we've got some outlier heroes. Specific tokens are bringing this explosive, high kinetic energy back to the altcoin sector today, completely defying the broader sluggishness.
Just look at this dynamic, brightly colored chart. For instance, Biconomy, or BICO, surged an incredible 87% over the last 24 hours. That was driven by a massive renewed interest in Layer 2 solutions and gasless infrastructure. Right behind it, Aventus, or RE, saw explosive growth of nearly 78%. What's really fascinating there is that Aventus is backed by massive institutional trading volume, over $191 million in just 24 hours. So while institutions are pulling out of Bitcoin ETFs, they are being highly targeted with their altcoin accumulation.
So with all these conflicting forces battling it out, retail buying versus institutional selling, altcoin surges versus macroeconomic headwinds, how do you actually trade this? Let's map out the critical tactical levels you need to watch to navigate this choppy, volatile environment. From a technical perspective, Bitcoin is currently compressing tightly inside a symmetrical triangle. It's building energy. Step one for the bulls is absolutely crucial. They must hold the $62,000 support floor. If that breaks, things get ugly. Step two, to actually signal a genuine uptrend and potentially make a run toward the $80,000 level, we need a decisive high-volume break above $64,760. Looking at the key price levels here, you can think of the $63,000 to $63,558 zone as your immediate defensive shield. If that fails, there's a strong chance we drop to test the devastating May cycle lows down at $59,130. On the flip side, breaking $64,760 is great, but $67,500, that is the heavy resistance level that absolutely must be conquered to confirm a true structural recovery. Until then, definitely expect some choppy, range-bound warfare. Now, let's zoom out to the broader macro sequence. Over the next 30 to 90 days, the narrative that could ultimately save the market relies entirely on this exact timeline. First, we need sustained lower oil prices over the next 30 days. That lower energy cost must then force a cooler July CPI inflation print in 60 days. Only then, at the 90-day mark, would the Fed's data-dependent committee actually have the justification to soften their stance and revise that hawkish dot plot in September. It's a narrow path, for sure. So, as we wrap up this explainer, I want to leave you with this final thought. Look past today's green candles. Keep monitoring the inflation data, watch those infrastructure threats like 40 bleed closely, and ask yourself, with the Federal Reserve's safety net completely gone, is your portfolio positioned for a genuine recovery, or are you just buying into a temporary illusion? Stay sharp, stay informed, and we'll catch you in the next explainer.